Hey there, guys. It's a lovely, beautiful morning here, and I'm all inspired to give you this wonderful, wonderful tip as to how you can buy something, a stock on discount in the markets. We're seeing a lot of bargain sales all over the place, and you must be wondering why can't we get any discount in stocks on the exchange? Well, there's a way. There's a way you can get a stock at a discount, and how is it possible? Well, that's the subject of this video. So it's a simple strategy, but it's restricted to stocks that are listed as an FNO, in the FNO category. So you can only buy these stocks on a discount if they are available in the stock exchanges in the FNO category. So let's go about it. It's interesting. I don't want to make you wait, and we will soon find out how we can go about it. Well, introductions first. The channel that you see here is Market Ideas for Profit. I'm Manoj Maheshwari. I run this channel, and we have a Telegram group where we circulate ready curated ideas for intraday and swing, for equity, FNO, and commodity, for the Indian and the US bourses. We have a premium channel too, which will give you more refined trades. I'll not say more refined. I mean, you have to value me, and if you value my ideas, you'll have to pay a bit to get into that premium channel. Well, you will get the value back in a very short time, so that's not to worry about. So this is it. You can visit us at this at this page called www.heymanoj.com. There's a lot of knowledge content there. It talks about all I do. I blog about what I see in the market, and yes, I do go out in the world, and once in a while, if I have to say something, I do get onto Twitter and voice what I think is something that I want to convey to the world. So introductions here. Let's dive into the next in the real meat of this video. Discounts, the stocks at a discount. So like always, I'll set the agenda for today's video. What we are doing is we are trying to understand what is a cash secured put. That's what the strategy is called when you want to buy stocks at a discount. And how do you trade to get a discount? What are the benefits of the strategy? Who should trade in this strategy? And what happens when it is not exercised? Well, exercise you will get to understand once you go through the first four subjects. Can this strategy be used for long-term investments? If that's the question that you want to have, yes, you'll get an answer with that, and an example trade setup to give you a cue as to where the stock is at the current situation, and where you are comfortable to buy it, and how you can go about buying it at the place you are comfortable to buy it at. So let's go with the first subject, which is what is a cash secured put. I'll give you a brief explanation of what a cash secured put is. For that, I'll give you a link on top where we have an eye icon where we talk about options. If you want to delve deeper into options, you can click on that link, and it'll take you to that subject where we describe a little detail about what are options. So basically, a cash secured put is, it involves selling a put option and simultaneously setting aside the cash to buy that stock if assigned. So you sell a put option which is in the money, and which is out of the money actually, and it's at a particular strike price at which you're comfortable to buy that stock. So if you're talking about, say, a stock which is current price is 100, and you think it's overpriced, and you think that 90 is a good price to buy it at, and if you want to buy it at 90, what you can do is, on that stock you sell a put which is at a strike price of 90, and what happens is, in bargain, you get a premium from somebody who's willing to buy that put at 90, and you sell that put at 90. So irrespective, you get a premium in any case. So you make an earning out of selling that put, but you have to put up an upfront margin to be able to get into that trade, and that margin is decided by the exchange and changes from time to time. But that margin is about you could say one third, 1/4, or 1/3 of the actual price of the entire lot of those stocks. So it's imperative to buy the stock in that quantity. That is the lot size that the exchange decides. So say for a Reliance, it is 250 shares, or a block of 250 shares is the minimum that you will need to buy if you want to buy this as a stock at a discount. So a put option sold at a particular strike price at which an investor is comfortable to buy is the first thing. And then the slated price is generally lower than the strike price is generally lower than the current market price. I already explained to you. If the price is 100 and if you're comfortable to buy it at 90, you sell the put of the 90 strike price. Now there'll be a small premium for it. It could be 5 rupees, it could be 10 rupees, it could be 30 rupees, it could be 20 rupees, depending on the stock value and the volatility in that stock at that given point of time. So whatever that amount is, it'll come to your kitty. It is right on the first day of you selling it. So the amount of money comes right into your account. And what happens if that put will, in the Indian markets, the settlement of every cycle happens on the last Thursday of the month. So suppose you decide to sell that put on the first or the second or the first week of the month or any time during the month, and on the last Thursday of the month, if that strike price is not the current price, then the trade goes to zero, and whatever amount of premium you want goes to your kitty. It remains with you, and your margin is returned back to you. So in that cycle, you did not reach that 90 rupee level, and the money that you receive from the premium of that comes to your pocket, and you didn't buy that stock. But if that price is exercised, you need to have enough cash in your account to be able to buy that stock in that lot size on that particular day when that contract ended. So that's the gist of a cash secured put. I'll explain more in the next coming video. So I hope you got this one right. If you didn't, please go through the video again, this part of the video again, and we'll dive into the next one. Here goes. So what are the benefits of this strategy, which we call the cash secured puts or stocks at a discount? By using this strategy, one can attempt to make an investment in a stock or an underlying at a price at which one is comfortable at. So you can, if normally what you would do is, if a price is at 100 and if you're comfortable with 90 or 85 or whatever the price is, you would wait, and you would wait for the price to come down, and you would not act in the market, and you would wait till it gets 90. You'll set an alert or whatever it is, and you'll keep marking up, and until the price is at 90, you'll keep on waiting. Well, yeah, that's a way of getting the stock at a discount, but it may not happen. And wouldn't it be better to keep waiting and still make money out of that waiting? So basically you're waiting and you still make money out of it, and don't need to set an alert, because you already set the price at 90 and you're willing to buy it at 90. The moment it gets to 90, well, you obviously will get an alert from whomever you place the bet with, or whomever you place the trade with, I mean the broker and the exchange, and they will communicate to you that look, your price is here and now is the time to put in the money and the stock is yours. So this is the benefit, one of the benefits of the strategy. If the price is not reached, you earn a premium, and you can say for the money that you put up as a margin, you're getting an interest on it, or you can say that's a rental income that you make out of the investment that you made in the terms of the margin that you put up. And you can also consider that as a discount, which you could put on the actual price when you get it. So if you got say a 5 rupee premium or a 2 rupee premium, and you are willing to buy it at 90, the ultimate cost on that stock is 88, because 90 rupees is what you're going to pay, and 2 rupees you already received in terms of the premium on the stock. So your eventual price is not even 90, it's closer to 88. So the rental that the monthly premium that you make is going to lower your cost basis. So that's one other advantage. And you can repeat the process every month. So suppose you said 100 and you wanted it 90, and this month it didn't happen. Well, you can go back and do that again. And there's other advantage in that. Suppose the price went to 95 in the last month, and now you want to lower your expected value from 90 to 85. So in the next month you could go for the 85 strike price. You no need to stick to 90. You can adapt to the situation, and if you feel that the market has gone down and your expected value has also gone down, you can adjust to that and you can go to 85 in the next month. And you can keep on repeating this cycle every month until you're comfortable to enter that stock. And and every month you can earn that discount. So while you're waiting, you're making money and you're reducing your cost basis. So it's a win-win situation. And on the date of reaching the strike price, the achieved price is at a comfortable price point, so you don't feel bad that the market has gone down, because you will still have bought it at the market price. and that could be the right price, and that's from where the price could go up. So these are the benefits of this strategy, and I'd say it would be, if you're really willing to invest in something, unless you're very sure that the market is going to go up and it's not going to come down, and if you're buying cash at the current price, I think you're not doing the right thing, because the market always gives you a good price, and the market is most of the time inflated, and it'll always give you an opportunity to enter at a lower price. So it's a good strategy to have in your bag. Okay, we'll go to the other things that we need to look at in this strategy in the next video. See you there. So there's a pertinent question. Who is the right person or investor or a trader to get into this strategy, and what are the qualifications for you to understand whether this strategy is meant for you or not? So only a serious willing buyer who wants to hold the stock for a certain length of time in the given lot size with the desired cash equivalent that he'll have to reserve if the price is hit, should be the one who should get into this stock. So you should not get into this strategy if you're only looking to make a rental income. You should have the cash equivalent in your kitty to be able to buy that stock if it goes to that price or below that price on the date of expiry. So these are the few things that you need to be sure of. You need to be somebody who's comfortable to hold that stock for a longer term, and not hold it, or not just buy the put or sell the put to gain the premium. That's not what the goal is. The goal is to be investing in that stock, because you need to have confidence in the long-term potential of that stock, and only then you should be able to buy it. So this is not somebody who wants to trade. This is somebody who wants to keep it as an investment for some length of time. The long-term view of the investor in that particular stock should be bullish in nature, and he should be willing to invest in the same for its capital appreciation alone. So the intention should be capital appreciation, and the intention of getting into the strategy should be to buy it at a more comfortable price, plus to reduce the cost basis by earning the premium for every cycle that it does not hit your comfortable price point. So that's the intent, and the main intent is that you're looking at the long-term goals of that stock, but you would want to buy at a little lower price than what the current market price is. And this decision to buy at a particular price point should not be taken alone on technicals. It should be fundamentally also in a sound situation. So when you buy the stock, you should be both good on your fundamental and your technical aspects of the stock. So you can do your research, and you can get only in that stock which has a long-term view. Well, most of the F&O stocks are stable, they have depth, but then there are some that are very highly volatile, and there are some that are less volatile. And the ones that you really are sure that are going to perform well in the long term, depending on the market cycle at that particular point of time, you need to make an assessment on that stock with a longer vision, and that's when you get into that strategy. So the acumen of the investor will definitely be a part of it. You can also consult your financial advisor or your financial planner and pose a question to him whether that stock is worth holding for a length of time, and what is a comfortable price to buy it at. That could be a cue that somebody can help you with. We can also help you with that. We do that every week for our investors, and we can also help you with that. But this is something to consider and qualify. If you fall into this bracket, is only the reason when you will get into this strategy. Some more nuances in the next video. We'll see you there. Welcome back. We've been talking about ifs and buts in the last videos, and let's now get to the chase and find out what happens in a given situation on the expiry. So if the desired price at which one wants to enter the stock is not reached, so like in our last example, if the current price is 100, your strike price is 90 at which you're comfortable to buy, and the price at the end of the expiry is 92, 91, or even 90.55. Well, that means that the targeted price of 90 has not been reached, and even at 90.05, you will not be allowed to buy that stock, and the premium that you earned will stay with you, and the contract will expire to zero because you sold it at a price of 90. It did not expire at 90, and that's it. So the entire amount of money that you took as premium can stay in as your own money, as the money that you earned for the amount of investment that you made, and the margin that you put in is returned back into your account. So that's what happens where if the price doesn't reach the 90, and you can treat that premium as ultimately a discount that you've already earned on that 90. Now for the next cycle, as the price is close to 90, you could choose to go to 85, you could choose to go to 80, or you could stick to 90, depending on your assessment as to whether that price is the price at which you want to currently get that stock at. And then the other eventuality, what happens in case that it goes to 90 or below 90? What happens then is that you will have because the stock has gone below the strike price, the exchange will call upon you to buy that stock and either pay the differential of whatever is the price below 90. So if it goes to 87, you'll have to pay 3 rupees as the cost to the exchange, the differential between the 90 strike price and the 87. Or what you can do then, in fact the exchange will just do that, it'll ask you to pay up the difference. But what you can do is, as the price has gone below the price at which you were comfortable to buy it, you just go and buy the equity on that day, and that will be the price that you will have to pay for that stock at that point of time. So you got a discount. You decided to, when the price was at 100, you decided to buy it at 90, and it went below 90, so you are happier because you got it below 90. That's the intent of this strategy, and you should be happy because you got it below 90. And there are ways then, after buying the stock, we will get into another strategy which I will comment upon later, which will appear like an icon. Once you get into that stock, I can show you a way of making a rental income on that stock after you've got that stock in your kitty too. So that's the subject of another video, which we call as the wheel strategy. You can click on that icon on the top right hand corner of your video, and you will see an icon where it talks about this strategy, and that's the part of another video. But after you get into that stock, we can talk about that in the next video, in the next subject, next strategy, which is called the wheel strategy. So this is it. If it reaches that goal of 90 or the strike price, you've got your shares at a discount to what the market price was when you initially designed the strategy, and so you've got it. You should be happy that you got the price which you're looking for, and we can go to the next steps then. And it will have been lower at the price at which you initially wanted to buy, because you'll have earned the premium too. So this is for this video. Let's skip into the next one. I might show you an example of how this works. So let's get into the next video in a bit. See you there. Hey there. I hope you've understood the strategy in the theory. If not, you can go back to the old videos and refresh your understanding. But I think this current video, this current chapter will give you some more understanding. So might as well look at this one and then go back. And if you don't understand, yes, you need to look at the video once again. That's the advantage of having a video. You can go back and look at it, or you can start from wherever you wish, that the portion that you haven't understood. So what I'm trying to do here is I'm going to show you an example of a scenario in which I would get into a stock at a comfortable price from the current price that I'm looking at. So we will look at Reliance, which is something that I consider as a stable stock and which should grow over a longer length of time. The current price of Reliance is 2600 odd. We are around the third week of August 2022. Now I'm more comfortable to buy Reliance somewhere around this area, where my technical understanding and my fundamental understanding allows me to get at a good price. And my intent is to see this stock come down. This is what my technicals tell me, that it should come down, and then I see that it should bounce to this price in the future. So my scenario is I want to buy Reliance at somewhere close to 2400, 2450, and see that it goes up to 3000. That's my scenario. Now what I could do currently is I could just keep on waiting currently until it reaches that 2400 level, or what I can do today is I can sell a put of the September cycle with a strike price of 24.65. Now if you want to look at this, what we can do is, in a jiffy, what we can do is we can look at the strike price that we would get in September for that strike price. So I'm sorry, but I will have to log in here, and I will have to log in. I'm just trying to get you to see what is the price of Reliance what is the premium that you will get when you want to get into that price. So give me a minute and I will just get into that. It'll just take a minute, nothing more. Once we log on, I can show you what is the price of Reliance on what is the price of that particular. So this is a tool that I'm using to give me a gauge as to what is the strategy going to look like. So I will enter Reliance in this here. I'll go to options. I'll go to the strike price that I'm going to the strike period that I'm looking at, and then here I will look at the strike price that we decided. Let's say we stick to 24.40. What I'm going to do is I'm going to sell a put, and I'm going to sell one lot, and this is the situation. So now what is happening is I'm getting an option price of 22 rupees for this strike price. So on investment of 96,000 rupees initial margin, I will make 5,500 rupees on that. This will accrue as a premium. So I'm getting 5.7% discount on the price of Reliance if I'm willing to wait for it for a month and for a strike price of 24.40. So this is what is the. So let's look at it, how it looks on the chart. Current price, like I said, is 2600. I intend to get in at 2465, and I expect it to bounce and go to 3025. So like we saw in the section there, you're getting 22 rupees as premium into 250. That's close to 5k odd for an investment of 96k. That's more than a 5.75% return for the amount of money that you've invested as margin for that period. And eventually you get to buy Reliance, you'll have to pay 250 into 2440, which is the price. 2440, which is the price, and less that 5k odd, which is already a discount. So you will eventually end up buying Reliance at 2418. So with the current price at 2600, you got at 2418. That's a 10% discount, and that's the intention of this strategy. I hope I have explained to you what it looks like, and you will make the rental income. You'll get a discount, and that waiting period will have been worthwhile, and you will be then able to buy the stock at that price. I hope you get it, and there is no way you will go, if you have the ability or if you have the intention to get into a stock in a given lot size, which is 250 for Reliance. You can get that list off from the exchange as to what stocks are available and what are the lot sizes. They're generally within the investment range of 4 lakhs to 7-8 lakhs depending on the stock that you want to buy. So you should have a portfolio which is looking to buy a particular stock with that investment in mind, and then you can hold it for a longer run. So I hope I have been able to explain to you with this example what a cash secured put is. If you need to know any more, you can definitely write to me in the comments section under this video, and I will be able to explain it to you. And maybe I have done justice to the subject and given you a complete explanation of this video. Maybe the next one, we will go on to the next one now. So in conclusion, what can we say about this strategy? Well, I call it's a proven strategy. It does not need much attention, and once you know what you're talking about, it's a no-brainer. Who would want to buy a stock at a current price if one can buy it at a discount? So at any given point of time, there's no clue that the price is only going to go up. It can go down too, and it's in human nature. Mostly in our communities and in our psyche as Indians, we want to buy things at a discount. It's a no-brainer, I guess. And it doesn't require your attention a lot. You can just decide to make a trade and wait for it to happen. It requires patience, of course. That's all it requires, and a little bit of acumen and awareness, and this meeting that you had with me by chance. It ensures better returns than in a fixed deposit or a savings account, because if you realize, if it doesn't strike the price, if you saw in like an example of Reliance I gave you, it would give you a 5% return on a monthly basis, which is unheard of. You can just get into the strategy and aim for a good return. If you lower your expectations, you would make 2% every month without doing anything major. So look at it, but that's not my intention with this strategy. With this strategy, my intention is to get into a stock which I can hold for a longer length of time. But for the waiting, it pays you more than what your bank will pay you, and most of the mutual funds will pay you, even without being invested in them. There's a case for a monthly revenue, and you're always looking at the appreciation of that stock, and with an added advantage on the next strategy, which is a wheel strategy, which is in addition to what we've done here, which I'll explain to you in the next videos. In the next subject, you could start making rental income from the stocks that you hold, and you have bought them at a good discount, so that gives you a cushion in terms of your capital risk also by deploying this cash secured strategy. And then you can choose the stock, and you can adapt. So what seems like good value today could not be good value today. So you have the ability to reduce that visualization of a good value after the first cycle is over. Like in our case, if 100, you were looking at 90 as a fair value, and then it could go down to 85 or 80 in the next cycle, and you always have a chance to adapt to it. I guess I have given you a brilliant idea to save money in this lesson. To remind you once again, this was a cash secured put strategy. This strategy is something that you can deploy with your money on a regular basis, and I'll encourage you to join us with your yearly subscription. We discuss the stocks that can go into the strategy every weekend, and we help you with understanding what can be done with your money and how can it be deployed in the right way. Besides that, we give a lot of trade ideas. If you do long-term investment and you are willing to expose a little bit of your capital to short-term trading, we float a lot of ideas there, and along with it we show the learning how that happens. So we believe in not giving you the fish, but allowing you to fish, in a sense, to teach you and educate you as to how you can be better at this game. Once you do this, it can add a money flow to your bank account besides the one that you already have on which you survive. So as a professional, you must be doing something, but it's not a bad idea to have a separate way to make money flowing into your account. Well, that's it. Aligning with me will help you do that. Thanks for spending this time with me, and until we see us next time in the next video, ciao, see you there, bye.